Investment. Investing can be one of the most powerful ways to grow wealth, but it's also one of the riskiest if you step in unprepared. Before you make your next move in the stock market, crypto space, or any investment vehicle, that there's a warning you absolutely need to hear. Ignoring this could cost you more than just money. It could shake your confidence, ruin your financial plans, and leave you questioning your entire strategy. One of the first things you need to understand is market timing risk. Many investors make the mistake of thinking there's a perfect moment to buy or sell. The truth is, markets fluctuate constantly, and trying to chase a peak or avoid a dip often leads to buying high and selling low. The exact opposite of what you want. Patience isn't just a virtue in investing, it's a requirement. Learning to wait for the right opportunities, to let trends develop, and to ignore the noise is what separates successful investors from those who lose their shirt in a matter of weeks. And another critical factor is emotional investing. Fear and greed are powerful forces. When markets are soaring, it's easy to feel like you're missing out, driving you to invest impulsively. On the flip side, when markets dip, panic can make you sell assets at a loss. Emotional decisions almost always cost more than analytical ones. Recognizing these triggers in yourself and developing a disciplined strategy is crucial. The goal isn't to react to every market swing. It's to react intelligently when the conditions truly call for it. Due diligence and research can't be skipped. Investing blindly is like walking into a dark room and hoping you don't step on something sharp. Every company you invest in, every crypto token you consider, every stock tip you hear requires a deep understanding. Look at financial statements, business models, growth potential, and broader economic trends. The better your knowledge, the lower your risk. Relying on intuition or luck is no substitute for proper analysis. Your money deserves that level of respect. Finally, beware of hot tips and trending advice. Social media, news headlines, or friends may push you toward investments that sound exciting but are fundamentally weak. Just because something is popular doesn't mean it's safe or smart. Independent thinking, grounded in facts, and careful research is your best defense. Being swept up in hype often leads to regret. Investment. Successful investors make their decisions quietly, calmly, and based on logic, not FOMO or fleeting excitement. So before you invest again, take a step back, check your emotions, review your research, and question whether your actions are driven by strategy or impulse. This warning isn't meant to scare you. It's meant to protect you. When you invest smartly with patience, discipline, and knowledge, investment, you're not gambling, you're building lasting wealth. And that's the difference between financial panic and financial freedom. When it comes to investing, one of the biggest pitfalls that many people fall into is trying to time the market. The idea of market timing is simple in theory: buy low, sell high. But in reality, it's one of the most difficult, if not impossible, investment things to do consistently. The market doesn't move in a straight line, and even professional investors struggle to predict short-term movements. When you enter the market at the wrong time, the consequences can be severe. You might buy during a peak expecting prices to continue rising, only to see a sudden downturn wipe out a significant portion of your investment. Conversely, you might hesitate to invest during a downturn out of fear, only to miss the recovery that follows. This constant guessing game can lead to frustration, impulsive decisions, and ultimately financial loss. Many new investors think they need to be perfectly synchronized with market trends, believing that missing a few days of growth could cost them their chance at wealth. The reality is far different. Wealth is rarely built in a single transaction or a perfectly timed trade. It is built over time through consistent, disciplined investment strategies. Understanding that markets move in cycles and that fluctuations are normal is essential. Market dips are not failures. They are opportunities for long-term investors to enter at more attractive valuations. Patience becomes one of your most valuable tools. By resisting the urge to react to short-term volatility, you give your investments the time they need to grow, allowing compounding to work its magic. Another aspect of market timing risk is the emotional strain it places on investors. Constantly watching charts, tracking daily market movements, and attempting to predict the next swing can lead to anxiety and stress. When emotions dictate decisions, investors are more likely to make mistakes, buying out of greed when prices are high or selling out of fear when prices drop. The key to avoiding these mistakes is understanding that short-term market movements are unpredictable and largely irrelevant to long-term financial goals. Instead, And successful investors focus on creating a strategy based on research goals and risk tolerance. They stick to that plan regardless of market noise, knowing that patience and discipline often outperform impulsive reactions. Finally, it's important to recognize that timing the market is not the same as time in the market. Time in the market allows your investments to grow, compound, and weather inevitable downturns. Those who try to perfectly time their entry and exit points often end up missing out on the largest gains. Learning to accept that the market will have ups and downs and that no one can predict every move is crucial. By acknowledging the inherent risks of market timing and committing to a patient, informed approach, you protect yourself from unnecessary losses and set yourself up for long-term financial success. Patience, not timing, is the real advantage in investing. One of the most underestimated dangers in investing is the influence of emotions. Fear and greed are powerful forces that can drive even the most rational investors to make decisions they later regret. When markets are rising rapidly, greed can push people to buy assets at inflated prices, thinking they'll continue to go up indefinitely. This is often referred to as FOMO, or the fear of missing out. The problem with FOMO-driven investing is that it overrides logical analysis and turns decision-making into a reaction to hype rather than a careful evaluation of facts. Investors may overlook fundamental weaknesses in a company, ignore unsustainable valuations, or take on excessive risk, all in the hope of catching the next big surge. While short-term gains may sometimes happen, these decisions are rarely sustainable, and the downside can be devastating. Fear, on the other hand, is equally dangerous. When markets experience a downturn or even minor fluctuations, panic can set in. Investors who let fear control their actions may sell their holdings at a loss, even when the underlying fundamentals remain strong. This behavior, often called panic selling, locks in losses and prevents them from benefiting from eventual recoveries. The market naturally moves in cycles. Ups and downs are part of the process, and reacting emotionally to every swing only amplifies the negative impact on your portfolio. The key is understanding that volatility is normal and that long-term success depends on the ability to stay calm during periods of uncertainty. Emotional investing doesn't just affect when you buy or sell, it also impacts how you approach your overall strategy. Impulsive decisions can lead to overtrading, chasing trends, or constantly switching between investments, which increases costs and reduces overall returns. Overconfidence is another form of emotional bias. After a few successful trades, investors might assume they can predict the market consistently, leading to riskier bets and potential losses. Being aware of these emotional pitfalls and taking steps to mitigate them is essential. Simple strategies like setting predefined rules for buying and selling, maintaining a diversified portfolio, and focusing on long-term goals can help counteract emotional impulses. Developing emotional discipline in investing is not about suppressing feelings entirely. It's about controlling them and making decisions based on logic, research, and strategy rather than immediate reactions. The most successful investors are those who can recognize when their emotions are influencing decisions and pause before acting. They understand that staying calm during market turbulence, resisting the urge to chase hype, and sticking to a well-thought-out plan is far more effective than reacting impulsively. In the long run, emotional discipline protects your capital, reduces unnecessary losses, and allows your investments to grow steadily, turning the inherent ups and downs of the market into opportunities rather than threats. Before investing a single dollar, it's absolutely critical to understand the value of due diligence and research. Far too many investors jump into the market based on a tip from a friend, a viral social media post, or the latest trending stock without taking the time to examine the underlying fundamentals. Investing without proper research is like walking blindfolded through a busy intersection. You might make it across safely, but the odds are stacked against you. The reality is that no amount of luck can replace informed decision-making. Knowing what you are investing in, why it has potential, and what risks exist is the foundation of smart investing, and neglecting this step is a fast track to losses. Due diligence begins with understanding the company or asset itself. This involves reviewing financial statements, revenue growth, profit margins, debt levels, and cash flow. A company might look appealing on the surface, but if it's heavily leveraged or losing money consistently, it may be a risky investment. Similarly, understanding the business model is crucial. How does the company make money? Is it in a growing industry or is it facing obsolescence? A company with a strong, Scalable business model and a competitive edge is far more likely to reward investors in the long term than one that relies on hype or short-term trends. Skipping misanalysis puts you at the mercy of market sentiment rather than facts. Next, it's important to consider the broader market and economic conditions. Even a solid company can face challenges in a declining industry or during a recession. Understanding macroeconomic trends, interest rates, and sector-specific developments allows you to evaluate potential headwinds and opportunities. It's also critical to research valuation. A great company bought at an inflated price is often a poor investment. Comparing key metrics to historical averages and peers helps ensure you're paying a fair price, not overpaying because of excitement or hype. Due diligence also extends to understanding risks and planning for worst-case scenarios. Every investment carries risk, and knowing what could go wrong and how much you can tolerate losing is essential. This approach helps you make rational decisions instead of reacting emotionally to temporary market swings. Finally, thorough research builds confidence. When you make investment decisions based on facts rather than speculation, you're less likely to panic during market volatility, chase trends, or make impulsive moves. It empowers you to stay patient, follow your plan, and focus on long-term growth. In investing, knowledge isn't just power, it's protection. By dedicating time and effort to due diligence, you give yourself the edge to make smarter, safer, and more profitable decisions. Investment, turning potential pitfalls into opportunities and transforming uncertainty into calculated action. One of the most common mistakes investors make is relying on hot tips or following the latest hype. In today's world, it's easy to get swept up by social media trends, online forums, or even friends who seem to have insider knowledge. Everyone wants the next big win, the stock that will double overnight, or the cryptocurrency that's going to make early investors millionaires. The problem is that these tips rarely come from a place of thorough research or deep understanding. They are often based on speculation, emotions, or the desire to create excitement. Following them blindly can lead to significant financial losses and missed opportunities for more reliable, long-term growth. Investment. The danger of chasing trends is that you're not investing, you're gambling. A stock may be trending because of a viral post or a celebrity endorsement, not because the company's fundamentals support its valuation. Investment. Similarly, friends or colleagues might share a tip based on what they heard elsewhere without any real analysis. Acting on these suggestions often results in buying at the peak of a hype cycle, when prices are inflated, only to watch the value drop once the excitement fades. The illusion of hot tips lures people into believing they have an edge, but in reality, it's the opposite. True investing requires patience, research, and a clear understanding of risk versus reward. Independent decision making is the key to avoiding these pitfalls. Successful investors focus on gathering information from credible sources, analyzing data, and making decisions that align with their long-term strategy. They resist the temptation to follow the crowd and instead evaluate whether an investment fits their financial goals, risk tolerance, and portfolio plan. This approach not only reduces the likelihood of losses, but also increases confidence in your decisions. When you make choices based on facts and logic rather than hype, you're in control of your financial future, rather than being manipulated by fleeting trends. It's also important to understand that investing is a marathon, not a sprint. Real wealth doesn't come from following the latest buzz. It comes from consistent investment, disciplined decision-making over time. While it may feel exciting to chase hot tips, this often leads to short-term thinking and impulsive actions. By focusing on long-term fundamentals, diversifying your portfolio, investment, and ignoring the noise, you create a strategy that can weather volatility and generate sustainable growth. Ultimately, resisting the allure of hot tips is about self-discipline and education. Investment, knowing how to analyze investments, understanding your own goals, and trusting your research over social influence protects you from unnecessary risk. It allows you to make decisions with clarity and confidence, transforming the unpredictable world of investing into a manageable, strategic path toward financial success. Following trends may feel thrilling in the moment, but informed investment, independent decisions are what truly build wealth and secure your financial future. Investing without research is like gambling investment, but investing with knowledge turns risk into a strategic pathway to building real wealth over time.